In today's video, I'm going to show you why 99% of forex traders fail in this business and what you should be doing in order to be among the 1% forex traders who make money week in, week out in the forex market. Now, this is a typical scenario where most traders will call this a boss break of structure, and they will simply look for a point of interest in here, especially the order block. They look for order block in here, supply and demand, or whatever it is. So when price comes back in, they want to take the sell position. But what eventually happens is that market trade take their stop here and then trade to the downside. The reason for this is because this is an inducement and market will need to mitigate in order to continue moving to the downside. In this video, I'm going to show you what you should be doing, what is true inducement, what is true mitigation, and how do you apply the opening price trading strategy to your advantage. We are going to look at the different type of mitigation, and also we are going to look at the chart examples and how to spot these on the chart. So without wasting time, let's move in. Now, the opening price strategy is simple. It's just about you trading around the opening price. Now, we have a market move up like this in a bullish market here. And before we move on here, we need to understand the anatomy of a candle. You see, when a candlestick opens for a bullish candle here, when it opens, it trades lower. This trade low is simply orders coming in. This is where demand will be stuck in. This is where smart money will be accumulating what orders. This week to the downside, in my last video, I talked about the market phase. So this market phase here is all about accumulation, meaning the manipulations of the lows and a break of structure to the upside. So when this market opens here, it trades lower, creating the low of that particular candlesticks, then move up to the high. Some people will take profit, and then at the end the market closes at this point here. Now, what is this telling you? This is telling you that the most important area for you to start looking for trades is at the what? The open price. If market comes down but fails to mitigate this candle and then probably move higher, this low that failed to mitigate on this particular time frame we're looking at, the low here is an inducement. So in the future, when price comes back down, do not be trading this. Even if it broke structure, don't trade this. You wait for price to come, tap into this here. This is the best place for you to look for your trades. Now, am I saying this will work 100% of the time? No. Definitely there's nothing that works 100% in forex. But however, this will simply put the odds in your favor and increase your win rate. By the time we look at the chart, you will understand better. So what do you need to do here? If this candle, for example, trades to this open here before moving up, that means that this particular candle here has been mitigated. That leads us to two things here, the types of what mitigation. We have the single candle mitigation and we have the leg of structure mitigation. A single candle mitigation is when price mitigates the open of a particular candle. Now, why is this important? This is important because with the open of that candle, you can go to your lower time frame and look for trade setups. Probably a shift in market structure here to take your trades to the upside if your analysis tells you the market is going higher. For example, if you have the market moving lower like this, okay, and they will say, okay, look for the order block here or a supply zone here, that when price comes back to that order block, that means the market has mitigated that move. Well, technically this is not so, because for the market to mitigate, you need price to trade to the opening price, whether it's in a leg of structure or in a single candle. Now let's look at the leg of structure mitigation. For a leg of structure mitigation, we have an impulse, correction, impulse. Okay, now obviously let's assume this is the origin. This tap into an open here. Let's just assume that this tap into an open, so that makes this eye what? A strong eye, because it has mitigated the open and broke structure to the downside. Now when you see a break of market structure, there are two areas that are very important when it comes to your point of interest. The first one is the flip area here, where the supply took out the demand, because demand came in here to push price to the upside. So for us to break this low here, we need to create a new supply in here to break this to the downside. That means this region here is a very, very powerful point of interest, meaning price will need to mitigate. By mitigating, I mean trade back to the open of the candle that led to this break, then trade to the downside. Okay, same thing applies for a bullish market. We have a bullish market here. This low mitigate a particular open price here. Now your best point of interest will be at the origin, which is here. The origin simply means the candle that started the move. Okay, not the other block. The candle that started, the opening price of that candle, we need to see price mitigate that opening price before we can take a trade. That will give you a high probability trade setup. And also the flip region here, which is the demand that took out this supply in here. Okay, so when this demand take out the supply, you can look for trades when price mitigate this region. These are the two best areas to look for what trades. So now when we come back to the single candle mitigation for a bearish move, we want to see price trades to the open. Okay, now by the time price fails to mitigate, let's say this market here, by the time price fails to mitigate this area, it makes this eye an inducement. So what most people will do is they will look for trades in here. Okay, even when this breaks structure, I will not be counting on this point of interest. Okay, if for any reason, maybe for a quick scalp, the price will simply needs to come back here to mitigate, and that is where most traders get it wrong. Price will come back here, they will look for trade because it created a boss. The price will needs to mitigate here before going lower. Also, if price fail to mitigate the open, the origin, if price fails to mitigate the origin in here, the high that is being produced, or the low, for example in this case, is simply an inducement. So price will need to take out that high or that low, mitigate the origin, and then move to the downside. So this is what I want to show you, the power of what the opening price. This is what I do most of the time to refine my point of interest in order to get a true mitigation. Okay, a good example, let's go to the chart. Now what I will be showing you here is simple, just showing you areas where price mitigates. You can see here, you can see this is the opening price. Price came, this is a recent trade I shared with my community. We took this trade to the upside here. Okay, so you can see the price market needs to what mitigate. This area serves two purposes. This demand here took out the supply that dropped this price, and also price will need to what mitigate the open. If you look at it, the opening price is where price traded to. Okay, now the question, some of you will ask me a question in the comment and say, okay, what about if price closes below the open? That is video for another time. Just like this here, we have price trading above this open here. Okay, there's a way we look at this. In my next video or subsequent video, I will talk about this. This is the best point of interest. When you get here, this is where you start looking for trade. You can see price moving and then rejected. Okay, now forget the fact that it took out this eye. You are not going to put your stop here. There are different ways you can enter this market that you have to back test with your entry modules to use. Another one is this area here. The price has mitigated this region. We have price mitigating this region, okay, before moving to the upside. Here price failed to mitigate. That makes this low an inducement. If we look at this low here, this is the opening price that led to the push. Now most people will say that this other block here has been mitigated, so because of that they will be looking for trade in here. They will be looking for trades in here, which is not advisable. Okay, I will not advise you to look for trade in here because this low hasn't mitigated this open. So what do you need to do? That makes this low an inducement. You wait for price to take out that low before you start looking for your trade entry. You can see it took the low, came back into the open price before price moved to the upside. So what I want you to do is simply backtest this. You can try it on different pair. Let's look at Euro USD, because the example I showed you there was on pounds USD. With Euro USD we still have the same thing plays out here. You can see the opening price here. Price came in. This is your best area to look for trades. Okay, now the first area here that took out the supply, price tap into the opening price here and move, but they move far. That doesn't mean this can give you a quick scalp opportunity, or in case you are holding it for a long time, you got your loss, you will have re-entered at the origin here. Okay, so you can see price after mitigating here, it moved sharply to the upside. Looking at here, we have this open here which was also mitigated. You can see price mitigated the open before giving you a trade to the downside. These are key areas that you should be using in order to profit from the market. Another area where I'm watching currently is this. Price has not mitigated, so this high here is simply an inducement. If price for any reason try to come up here, I may not be interested in here. Okay, instead I'm looking at this high for a short to the downside. Looking forward here, you can see the opening price here. We mitigated this opening, price tap in, fly to the upside. So now this low did not mitigate this open, neither did it mitigate this open. So this low in the future is inducement. I should have asked you what you think is an inducement, because when price comes in the future to this low, I will not be taking trade here. Okay, most people will take here, so this other block has been mitigated, so they start looking for trades. My answer is no. You wait. This is your best point of interest here. The opening price here is your best point of interest. So you wait for price to take out the low here, tap in here for market to react, and then you look for your entry modules to take your trade. Now looking at this is the origin that's cleared this low. Okay, the latest supply that took out this low was this level here, and as you can see, price mitigated, gave a reaction. Okay, but eventually price needs to tap into the origin. So price came back to the origin here. You can see here the origin, the opening price that led to this move, mitigates and then push to the downside. So this is what I'm showing you here. Very powerful. This high did not mitigate. So what does it make this high? Put it in the comment section. What does it make this high? Yes, inducement. And as you can see, price came in, took out that high, and did what? Mitigate the open. This open, price mitigate that open. Let me draw a line there. Price mitigate that open, and what do you see? A push to the downside. Now the reason why this didn't continue was because we have a change of structure in here, and hopefully this was just for an intraday trade to a particular level before moving to the upside. Try backtest all of these ideas. They are very powerful. In my next video I will do a part 2 series on these, so you will understand it better how to trade them. Okay, now remember, they are not holy grail. Like here for example, price just went through it. Okay, so you're not simply putting limit orders. There are different rules to these things, and with time you are going to understand it. So that is the opening price. If you enjoy it, let me know in the comment section. Like this video, subscribe, and make sure that this video gets to as many traders as possible. And on that note, I will see you in this video.